Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Jon Maier, Chief Investment Officer at X. X offers 107 ETFs with more than 40 billion in assets under management in the US. We are talking about the second half market outlook and Jon's favorite themes. Jon, welcome back. Pleasure to have you on the show.
Thanks for having me back, Neena. One of my favorite podcasts.
Sure, thank you. So stocks are on pace for their best first half in 40 years, defying skeptics and climbing over all walls of worries. And this rally is primarily driven by mega-cap tech stocks that have benefited from optimism about artificial intelligence. But the economy, the labor market, and American consumers have proven to be much more resilient than experts believed, at least up to this point. Most economists still expect a recession in the US later this year or early next year. And this most anticipated, most talked about recession in history just keeps getting pushed out. So I wanted to start with your thoughts on this impending recession. Do you think the US can avoid a recession this year, or a recession is imminent?
That's the trillion-dollar question, right? Or multi-trillion-dollar question. Can the economy avoid a recession? Or does it even matter if we hit a light recession? So I'm going to step back for a minute. So when the Fed paused at its June meeting, a question that was asked was would there be enough information to prompt a hike in the July meeting just about 6 weeks after that June meeting? And the Fed is looking at data, and two of the most important data points that have been proving to be rather resilient are the cyclical sector of housing and durable goods spending, very resilient, which is making the Fed's job a lot more difficult. Now, we're also seeing a housing bounce back. So housing is the most interest rate sensitive sector of the economy, tending to turn down before the rest of the economy and then continuing to drop until the end of the economy as we go into a broader recession. I'm not the type of person to say this time is different, but this time does seem a bit different. So the housing data showing some rebounding already from last year's downturn. We're seeing the third monthly increase in home prices in a row. Prices were higher in most major cities. New home sales bottomed last summer and have been rising ever since, despite high mortgage rates. And existing home sales have leveled off, again, despite high mortgage rates. Then on the resiliency of the durable sector is posing another challenge. Normally, both in the run-up to recession and during recession, spending on durable goods drops. During times of uncertainty and weakness, people don't want to buy big items, whether it be cars or appliances or houses. Today, growth in nominal shipments of durable goods is slowing, but has not turned negative. So going back to the question that you asked, can we avoid a recession? I think the answer is we can. I think it's possible. What defines a recession? 2 negative quarters of GDP growth. Can we have a very light recession and the market doesn't matter? Sure. So I guess what I'm saying is that we are slowing down. Whether it hits a technical recession, maybe. Does it matter? Probably not.
Right. And in fact, you believe that there are many opportunities, attractive opportunities for investors despite this impending economic slowdown. In fact, in your note, you called it a slowdown where opportunities abound. Please explain.
Sure. We do say that we are expecting a shallow recession, but to your point earlier, it does keep getting pushed back. Could that happen in the fourth quarter of this year? Perhaps. But the markets do look forward, and recessions are the shortest part of a business cycle. So looking forward, what's going on? We know the AI story, the artificial intelligence story, reshoring, and infrastructure investments. They're powerful structural forces that are reshaping productivity globally. We know that the free money era is behind us, at least for the time being. Companies and investors have to adopt strategies and prioritize efficiencies. So you have asynchronized economic contractions, which are likely to keep global real economic growth positive, both in 2023 and 2024. And continued growth in certain regions combined with asynchronized nature of the slowdown is likely to result in a smaller impact on commodity demand relative to prior contractions. We've also, during this period, because there's been such a tremendous amount of underinvestment in companies' infrastructure, the CapEx cycle is super strong. This is an area where companies are spending to enhance productivity, and AI just feeds into that story. The tight labor market just feeds into that story. So continued CapEx spending, despite weakening credit conditions and the decline in profits, has contributed to the strength of the U.S. economy. So onshoring and nearshoring have increased factory investments in and around the U.S. Inflation-adjusted construction spending in manufacturing sectors have jumped. And then more recently, you've had the AI revolution, which increases the need for companies to invest in productivity enhancements, pivoting in line with some of the mega trends that are reshaping all aspects of the efficiency in the workplace. And this application of technology has the potential to change market leadership across many different industries, from technology all the way to simple manufacturing to improve overall efficiencies.
So with that backdrop, how should investors be positioning their portfolios for the second half?
So the way we look at it, Nina, is that we look at a core. Where do you want the bulk of your portfolio to be and to be focused on? If you look at some of the macroeconomic conditions that, slowing growth, potentially widening credit spreads, pockets of resiliency in the market for sure. But knowing all of this, how do you want to be positioned? And I think the best way is to have a defensive and quality-focused core. So you have defensive companies such as consumer staples, healthcare, utilities, which are less sensitive to economic contractions. These are areas reflecting areas where consumers have less discretion on spending. They have to spend in some of these areas. You complement this with a quality focus that looks at companies' balance sheets, their cash flow strength. And if you combine this in a portfolio, this can establish a great core. And then you have dedicated exposures that benefit from increased investments in other areas, like in AI, like in onshoring, like in infrastructure. You're looking for those productivity enhancements. You're pivoting portions of your portfolio with the ways of technological change, because that's important to stay competitive. AI, as we know, is revolutionary technology that's new, that just started being in the public domain. But from our perspective, we believe that it's real. It's starting, as you mentioned earlier, from large companies that have large access to data. And so it's coming from top down. And companies are going to be able to pivot and maintain and fortify their competitive advantages in a world that's changing really fast. This applies both at the corporate level, the national level, with both economic and geopolitical benefits accruing to the regions leading this technology.
All excellent points. Now, let's talk about some thematic investing ideas, because Global X is a leader in thematic investing. So first half of the year has been great for many thematic ETFs, particularly technology and AI-related ETFs. But your best performing ETFs were Global X Blockchain ETF and another Bitcoin and blockchain ETF, which were up about 100%, but saw very little love from investors. In fact, that's the case with most blockchain and Bitcoin related ETFs. The best performing ETF of the year is a tiny ETF. Less than 10 million in assets has seen no love from investors. An area which has seen a lot of love from investors is AI and robotics. So your Global X Robotics and AI ETF BOTZ that gathered almost 650 million in assets. And other Global X Artificial Intelligence and Technology ETF, AIQ, that also saw a lot of love from investors, about 180 million in inflows. And both these ETFs are up more than 35% year to date. You still like this theme, robotics and AI. Do you think there's still room to run for these stocks and ETFs?
I do. And this is why that I think that robotics and artificial intelligence are areas that are very relevant in many different ways. First of all, this particular ETF, ETFs in general actually, are composed of many different companies. So the great part about an ETF is that you get some diversification by buying that ETF, whether it be a broad-based index like the S&P 500 or something more narrow like artificial intelligence and robotics. So you're not just buying one company. And generally, people buy more than one ETF, so you're getting many different companies that you're purchasing related to some theme or certain area that you're interested or feel like there's a benefit because of certain market dynamics. So the positive of the ETF structure should be recognized. Second, with respect to artificial intelligence, this is a very new area. And we know that ChatGPT was rolled out in November. The adoption rate, meaning user signups for that system, has been nothing like we've ever seen. Quicker than the internet, quicker than any other technology. If I think about how I use ChatGPT in my everyday, whether it be purely from correcting grammar on a particular piece that I'm working on, or throwing in 10 ideas into ChatGPT and say, write a paper for me, and then start there as a base, and then certainly support it and change it over time, it improves my efficiency. It saves time to kind of get over that initial hump of starting to write a paper. So it's really benefiting me in my everyday. When I think about how the technology can be used for others, it's able to do some of the work for lawyers and judges. It can pass certain exams, which is both a positive and a negative. But the applications really are endless, both from the technology side, as I mentioned earlier, down to the manufacturing side. And in an era when labor is tight and unclear when that's going to loosen up, because we've seen labor hoarding, companies not so quick to reduce their workforce. Any way to improve the efficiency of our personal life, our business life, is really important. Now, the underlying technology behind ChatGPT or OpenAI, it's smarter by several orders of magnitude than previous AI processes. Essentially what happens, these technologies are democratizing access to these automated decision-making in a way that we have never seen before. And I think this is just a new chapter in the rise of artificial intelligence. These models are faster, cheaper, more accurate than previous AI systems that were not available to everyone at the time. Has the potential to spur massive amounts of innovation, boosting productivity, powering a whole new set of applications and tools. Some we know, some we don't know. So as AI matures, we expect other themes to intersect with AI, like cloud computing, like cybersecurity, digital media would also receive a strong boost. This allows different platforms in these areas to solidify their positioning and compounds the addressable market opportunities at their disposal. So it's not just AI. AI doesn't live in a world of its own. It intersects. It intersects with cloud. Cloud is foundational to AI model adoption. We found that there's a strong correlation between the rise of global data assets and the revenues earned by public software as a service or SaaS companies. As global data assets continue to grow, consumption of cloud deployed software will accelerate to try to keep pace with that demand. And then there's obviously the protection of our data. Given the vast amounts of data that's prevalent in these operations, cybersecurity operations are really important. And the scope for AI, as we know, is massive. So the intersection between the putting our data up in the cloud, protecting that data. And most of the AI systems deployed today in security applications monitor data generated by large corporate IT systems for signs of breaches or malicious behavior. There's certain vendors like Zscaler and CrowdStrike, and there's some of the major providers of AI machine learning integrated offerings in the industry that'll protect the data. Cybersecurity companies are only going to need to improve their product suite to work alongside the massive adoption of AI across the board. So over time, will we see fits and starts in terms of returns on different companies? Sure. But the trajectory really is going in one direction from our perspective.
All very interesting. And I agree with you that we are still very early in this AI revolution. And it is a revolutionary technology, so a lot of potential. And I like your point regarding these technologies working together. They are needed for each other and they enhance each other's capabilities. So excellent points. We'll have to leave it there, John. Thank you so much for joining us today and for sharing your insights.
Thanks, as always.
That was Jon Maier of Global X ETFs. Now let's take a look at some thematic ETFs that you could consider if you're interested in implementing those ideas. Robotics and AI ETFs are very popular this year, and two products by Global X, they're excellent and very popular. They're Robotics and AI ETF, which we mentioned earlier, BOTZ, and another ETF, Global X AI and Technology ETF. The ticker symbol is AIQ. Another ETF which is worth a look is the oldest in this space by ROBO Global. The ticker symbol is ROBO. And there's one by iShares Robotics and AI ETF. The ticker symbol is IRBO. It is one of the cheapest in this space. Now looking at cloud computing ETFs, the Global X Cloud Computing ETF is CLOU. Another one which is worth a look is by Wisdom Tree. The ticker symbol is WCLD. Talking about cybersecurity ETFs, Global X offers BUG, B-U-G. Easy to remember. There are some other cybersecurity ETFs that are worth a look. The most popular product is by First Trust. The ticker symbol is CIBR, CIBR. The oldest product in this space is by ETF MG. The ticker symbol is IHAK. One of the cheapest is by iShares Cybersecurity ETF. The ticker symbol is IHAK. In full disclosure, I own the Global X Cloud Computing ETF, CLOU, the iShares Robotics ETF, ticker symbol IRBO, and the Cybersecurity ETF, IHAK, in the ETF investor portfolio that I manage. Thanks for listening. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. Also, make sure to subscribe so that you do not miss any episode. If you have any comments, questions, or suggestions, please email podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.